So this week, the sterling trade-weighted index hit an all-time low. That index goes back to 2000, and as you can see here, we've gone from 90 to 70 on that index. It's a fall of about 28%. That's starting to hit the headlines in terms of company news, and we've had the issues with Unilever and Tesco's this week. And we also had the week before the hike in the cost of fuel for EasyJet because of that dollar denomination of the fuel bill. So it's definitely something that we need to read into what's going on in our companies within portfolios. And a 20% fall in sterling equates to around 12 to 13% increase in import prices, so it's very important. Inflation is the transmission mechanism between a weak currency and the economy. And last week, with the steep move in sterling, we saw a very big move on Friday in inflation expectations. And here you've got the five-year inflation swap, which shows that move from just around 3% inflation in 5 years, the next 5 years up to 3.5 by the end of the week. This will put more focus on the Bank of England inflation report. We've got that on the 3rd of November. So in August, we've got a reading expectation of 2.4% CPI, and there will be significant focus on whether that's moved, subject to the sterling move. High inflation requires a bigger risk premium when you're buying UK bonds or gilts. And as we can see here, despite the fact that the Bank of England have been buying back treasuries, that yield on the 10-year has started to rise. Inflation rising and going above trend makes it more difficult to cut rates. And then therefore we go back to this conversation that we've been having for a couple of weeks now about whether we're seeing an inflection from monetary to fiscal policy and what that will ultimately mean for bond yields. So what do you buy when inflation is rising, and what long-term trends could invert because of this shift in inflation and perhaps shift in bond yields? Well, here we've got value versus growth. This trend has been extremely strong in terms of its correlation to falling bond yields, where growth has outperformed value significantly since 2005. Equally, there's another trend going back to over the last 12 months where staples have outperformed banks by a very big margin, again, following, in this case, the German 2-year yield. Other areas like cyclicals versus defensive, stocks with big pension fund deficits, low volatility stocks or high yield stocks have also had very strong periods of performance. And if we are seeing an inversion in direction for inflation and bond yields, those trends could also invert. Equally, this week we've also seen a further devaluation of the RMB, and we're now looking at the trade-weighted US dollar index back towards the levels that started to cause issues at the end of last year, and we saw very weak markets. And as you can see, here's the MSCI World in the very early part of this year in January and February. So we need to focus on that. What we do expect though as we go into Q3 numbers, which really have started now, and we'll look at what's coming up next week, is that this very big performance dependency on what sector or country that particular company is listed in will start to move back to the individual names, or start to focus back on stock-specific issues. And it's a good time to refocus on the core names within portfolios. Next week, it will be very busy. In terms of the Killik house stocks, we've got J&J, Goldman Sachs and Harley Davidson on Tuesday, Travis Perkins and eBay on Wednesday, Union Pacific, PayPal, Walgreens, Verizon, Microsoft on Thursday, and then Whirlpool and S&P, SAP on Friday. That's it from me. Thanks very much.